Hey everyone, I want to share a stock today that I own in my personal portfolio that is a stock that everyone out there completely hates. And for this reason, I like it even more. I am talking about IBM and why it is in my personal dividend stock portfolio. Hey everyone, this is Ian. I am back with another video about dividend growth investing. Today's video is all about IBM. This is a stock that I own in my portfolio. It's one of the very few tech positions that I own in my dividend stock portfolio. In fact, it may be the only tech position that I own right now in my dividend stock portfolio. I also own some tech stocks in my angel investing portfolio, but that's a separate topic. And right now, everyone seems to just hate IBM, especially the analysts out there, the investment analysts. That cover IBM, they talk about IBM, they just don't like IBM. And for that very reason, I like it even more. And I want to talk today about the position that I hold in IBM, some of the pros of IBM, some of the cons from a dividend investing standpoint. So, as I always do, I've got my notebook here. And I want to start out just with a high-level summary of what's going on. IBM is a company in transition. They've been through many transitions over their history. When they got started way back in the day, this is a company that was involved in mainframe computers, and they still are, but that was the bread and butter of their company. They made a transition to adding in consulting services in their portfolio. And in most recent years, they're now transitioning to adding other new services into their portfolio, such as services and technologies, that is, such as cloud computing, data analytics, and artificial intelligence. So point number one here is IBM has been a company in transition for its lifetime, but it's one of the oldest tech companies around. And what I've found, having worked in technology, is all tech companies have to evolve. And they have to adapt. All companies, in fact, have to do that, but tech companies, they have to do it more than other companies. And so what I like about IBM at a high level is that it has a history of evolving. It's already made it through evolutions, whereas some of the newer tech companies, some of the ones that have just popped up in recent years, maybe they don't have that as much in their DNA just because they're producing newer technologies since the internet generation that have not had to evolve that much, because they're new. But what I like about IBM is they've shown a track record of evolution, and for the last 5 or so years they've been in another evolution. They're trying to invest in cloud computing, artificial intelligence, data analytics, and hoping that that will drive revenue growth once again. Because this is a company where revenue growth has been stagnant, if not declining, over the last many years. And so the way I look at investing at a high level is all companies will go through a transition at some point or another, especially when you're a dividend growth investor like myself. You buy for cash flow, you buy for the dividend, for passive income, for increasing streams of dividends over time. One like myself, I hold companies forever. I buy them and I never have the intent to sell. And so when one has that approach, it's not a game of fine-tuning. It's not a game of analyzing every little thing. It's not a game of maybe filling in with a pencil these very small circles and squares. What it is it's broad brush strokes. It's creating a painting with very broad brush strokes. And so I look at the macro picture. I look at what's going to happen 10, 20, 30 years from now. I'm not so much concerned with, oh no, they did this quarter and that quarter. Oh, they missed their number by 1 penny and the street is punishing them for it. I look at those things, but I don't place a lot of value on them the way I place value on the broad picture, the broad brush strokes. And so with a company like IBM, yeah, revenue has been declining. They haven't been seeing the growth, but they're going through another evolution like they have in the past. And actually, it seems like it's starting to pan out, because in the most recent quarter, they showed their first revenue growth in a long time. And I wrote this down, these new businesses that they're involved in, these new business ventures are now 46% of revenue. Cloud computing, artificial intelligence, and data analytics are 46% of revenue. These are new businesses that literally did not exist. They probably only started getting into these businesses within the last 10 years. And you know what? IBM's revenue is $79 billion. So they have literally created 32 some odd billion dollars worth of revenue value in these new businesses within the last 10 years. That is phenomenal, and it shows why I like them, because it's in their DNA, this evolution, and they're doing it once again, in my opinion. So I want to dig into the numbers a bit today. First and foremost, the PE ratio, price divided by earnings on IBM right now, is 13.87. And I wrote that down here. That is phenomenal. In this market, most of the positions in my portfolio, or a lot of them, are over 20, and some of them are in the mid to high 20s. To get a stock in this market for this kind of PE ratio is awesome, and I like that. In other words, what this means is if IBM just stays stagnant, it doesn't go anywhere from where it is now. It will take 13.87 years worth of earnings to pile up and to basically equal the value of the current share price. That's not bad. Even in a bear market, a PE of 13, that's a good PE. It's not a great PE, but it's a reasonable PE for a firm like this, and so I really like that. Before I actually get to more metrics, I put the chart here. It's down. Literally, the price per share for IBM in the last 5 years is down. It's gone from $200 down to about $166 and change. I like that. Personally, when I average into stocks, when I buy stocks, I sometimes really like a downward trajectory because it basically provides a buying opportunity for someone accumulating shares for the long term. So anyways, it's down, and everyone hates it for that. The analysts hate it for that. But I take a contrarian perspective because I'm investing for cash flow. I'm not investing for a quick trade. I'm not investing for quick upside like many people do. And so it puts me in a unique frame of mind. More metrics. The current dividend yield is great for dividend investors. It is 3.69%. That is a wonderful dividend yield, a starting dividend yield on a global blue chip company. It's a big company, a market cap of $153 billion. This company is worth $153 billion. And in this market, in this day and age, when everything has gone up really high, when everything is trading at a premium, IBM is paying that solid yield. And the payout ratio is reasonable. So the payout ratio is 48.49%, meaning just less than half of earnings are being paid out to shareholders. And so payout ratio, oh, I didn't write it on here, is great. Dividend is up. They are raising the dividend, and they've raised it 58% in the last 4 years. I love that. This is a channel about investing for dividends and passive income. Well, and also other personal finance topics, but mainly dividends and passive income. The dividend starting yield is good on its own, but if they can continue raising it at the clip that they have, my yield on cost is going to be phenomenal. And so I believe it's a reasonable good time to average into IBM at these prices. So I've been talking a lot about upside. Let me talk about downside. What is the number one thing that I dislike about IBM? It is the debt. This company has $46.8 billion in debt. This is a lot of debt. As I had mentioned earlier, the revenue is $79.1 billion. So the debt as compared to revenue, it's up there. The debt as compared to market capitalization, it is up there. Typically, stocks in my portfolio do not carry this kind of debt. IBM has been playing a little bit of financial engineering over the last 5 or so years. They have been basically taking out debt at these low interest rates to buy back shares, and it's been helping their earnings per share. And generally against this type of activity, I generally don't like it, and it's something that would be a clear con on IBM. And if you've been following my channel, you know that I have core positions, medium positions, and ancillary positions. For this one reason alone, I classify IBM as an ancillary position. Maybe one day it could kind of reach a medium size position. It will never be a core position. That being said, in the world of tech stocks, I like this for my dividend portfolio and I want exposure to tech, and I selected IBM because of out of the universe of tech stocks out there, I like where they're going, especially with the artificial intelligence with Watson. I think that could be a game changer. But I also just like where they're going from a valuation standpoint, a dividend standpoint, and a track record. And over there, I think they've been in business for I don't know how many years now, but many, many years, they have shown this ability to adapt. And so I like that. And most other tech companies out there, they just don't have it. And for this dividend growth investor, that track record is quite important. So what else? The analysts. Let's talk about analysts for a minute. So analysts out there, someone was asking me this question. I'm going to do a completely different video about analysts. But there are analysts out there who monitor stocks. And there are really two types of analysts. There are analysts who evaluate stocks because there are managers at their company managing mutual funds that use their analysis to make decisions. There are other analysts out there who are evaluating stocks basically to help salespeople acquire more business for the investment firm that they work for. Regardless of what type of analyst you are, I take everything that these analysts say with a grain of salt. And the reason for that is I don't know if they have hidden agendas or not. I don't know what their end goal is. I certainly know that their focus is on the now. They're looking at this quarter's report, this year's performance. They're looking at these, they're painting not with broad brushstrokes, but with a pencil. They're literally making these micro level annotations. And for me, I'm just looking so much further out. My philosophy oftentimes just doesn't work with analysts. It doesn't jive with Wall Street analysts. And I think that's a good thing. It sets me apart. It puts me in a different arena. I'm playing a different game. And because I'm playing a different game of living off passive income and cash flow, I can just look at things differently and I don't have to get so caught up in the quarterly numbers. So you may be thinking, Ian, you've been covering some stocks here on your YouTube channel recently. What are you buying IBM right now? So here's the deal with my personal goals for 2018. I just did a video on this, and my personal goal this year is around buying core positions that are also values. Core positions are ones that have a great position in my overall portfolio, a great percentage. Not only now, but when I live off of passive income in the future, I want them to be driving the lion's share of my passive income. That's a core position. And then I also want core positions that are values. So I'm really focused right now, quite frankly, on Procter & Gamble and Kimberly-Clark, and I did an entire video about this. Covering IBM here and how I think IBM is a reasonable valuation for dividend investors in this market. But the fact of the matter is IBM right now is not a core position of mine, and I don't ever foresee that it will be. And so it doesn't meet the first criteria. Surely I believe for my portfolio right now it's a reasonable value, but it's not a core position. And so I'm not going to be buying a lot of IBM this year, although I'll probably be nibbling. I'll probably be buying some IBM over the course of the year just because I think it's a reasonable time to buy when it's at 5-year lows. It's been declining for 5 years. And they're finally starting to turn things around with these new businesses representing 46% of revenue. And they have a great path on dividend growth. I have the opportunity to have a really high yield on cost. I'm concerned about the debt. And that's another reason. I'll nibble at it. I want that representation of technology in my portfolio. But the debt is something that keeps me from going a little bit too far with IBM. And so at the end of the day, I want to share just a meta level takeaway from the video today. In the world of dividend growth investing, when the street, the analysts, the press out there, they dislike a certain stock, not only dislike it, they may even hate that stock, that is usually the time that I look at that stock seriously. Because those oftentimes create great buying opportunities for someone that's painting with the broad brushstrokes that is in this for a very long time for passive income. Because I just don't have to get caught up in the day-to-day. Was this quarter bad? Was this quarter good? I look at it at a higher level. And oftentimes that's why I look at the annual reports and place a lot more emphasis annually, especially multiple annual reports, than just looking at the quarterly reports, the 10Qs here and there. I hope you enjoyed the video today. My name is Ian Lopuk. I'm from ppcian.com. The greatest way that you can thank me for producing this type of content on YouTube is by giving me a thumbs up, a subscription, a comment. All of that means the world to me. It fuels the content here on my channel. Also, just a quick heads up, a full disclosure, I own IBM in my portfolio. I'm long on IBM. I also own Kimberly-Clark and Procter & Gamble. I am long on Kimberly-Clark and Procter & Gamble. Also, before I leave today, an important note, I am not a financial advisor. Today's video is not investment advice. Today's video, it's just for your fun and entertainment. If you are going to go out and invest in the stock market or anywhere else, please do consult a licensed financial advisor first. Thank you so much for watching today. I wish you all the success in the world. I wish you really a huge 2018. If you're investing for cash flow, for dividends, for passive income, it is so exciting. It's a great time to be involved. It's always a great time to be involved with passive income. And so here's to your dividend snowball, one day paying for all of your living expenses. Thank you for watching. I will see you in the next video.